Hey guys, welcome back. Today we are going to discuss one of the most loved indicators that traders use in almost all the time frames, the moving average convergence divergence, or simply the MACD indicator. In this video, I will be discussing the MACD indicator in detail, which will range from talking about the basic stuff that forms the indicator to discussing why the indicator really works in the market. We will also take a look at the common mistakes that traders make while using the MACD indicator. Finally, I will talk about some of the general strategies that we can make use while trading using the MACD indicator. I will discuss more unique strategies in yet another video so as to maintain the time constraints. As always, let's get right on with the business without wasting any time, and make sure to like and share the videos and subscribe if you like the channel content. MACD, or moving average convergence divergence. It is closely related to moving averages. Just like a moving average, MACD is also a lagging indicator, which means the MACD signals can actually give you a future price prediction, or simply the signals come after the price has actually made a move. But as a trader, we should not be disheartened by this very idea, because if we understand the basic characteristic or the nature of the indicator, then we can for sure make effective strategies that work in the market. MACD consists of two lines, the MACD line and the signal line, along with a histogram. Now let's dig deeper into what these lines mean and try to make some sense. If you have used the MACD indicator beforehand, you might have observed that the default setting is MACD 1226 close 9. What does this actually mean? Before getting started, you will have to have a fair understanding about the significance of moving averages to understand the concept better. So, I recommend you to watch this video on moving averages that I have posted earlier, and then proceed with this video. Alright then. Let's talk about the MACD line first. All you need to do is to take the value of a 12-period EMA or a 12-period exponential moving average and subtract that values against the 26-period exponential moving average. The result of this subtraction will also be an exponential moving average, and that is your MACD line. You might have noticed that the MACD line was actually derived from two moving averages mentioned. So, the MACD line is also considered as the first derivative of moving averages. Therefore, the MACD line moves slower or lags behind the 12-period exponential moving average. Now moving on, let us consider the MACD line values and plot an exponential moving average for 9 periods, or simply consider the 9-period exponential moving average of the MACD line. So what you will get is a signal line. Again, the point to be noted is that the signal line was derived from the MACD line, so it lags behind the MACD line. And of course, for all these calculations, we will be using the closing prices as default. And the final component of MACD is the histogram. The MACD histogram is the difference between the MACD line and the signal line. The histogram is actually a measure of strength of a particular move in the upward or downward direction in the market. The histogram oscillates around a central zero line. Above the zero line, the values are positive, and below the zero line, the values are negative. So, as a conclusion, what makes the MACD indicator so informative is that it actually employs the combination of different types of indicators. First of all, MACD employs the use of two moving averages of different periods, which are actually lagging indicators, and these can be used to identify the market trend or the market direction. Secondly, MACD plots the difference between the MACD line and signal line as a histogram. This histogram oscillates above and below a central zero line. The histogram is a good indication of the security's momentum. So if we were to give a general interpretation of the MACD indicator, we can say that when the MACD is positive, that is, it stays above the zero line, and if the histogram value is increasing, then the upside momentum is increasing, or simply it signals an uptrend. On the other hand, when the MACD is negative, which stays below the zero line, and the histogram value is also decreasing, then there is a downside momentum, or it starts a downtrend. I hope by now you have a fair understanding of what the MACD indicator truly is. Now, let me share some of the common mistakes that traders make while using the MACD indicator. Number one is trading the MACD crossover. This is a widely popular technique, but the real problem with this technique is that it only works in strong and trending markets. But we have to remember the fact that most of the time, the market stays in a range. So what this does is that MACD crossover will give many false signals, and thereby the traders will face large losses. Number two is misinterpreting the MACD histogram. Whenever there is a strong momentum move, most of the traders just jumps into conclusion to buy the stock just by looking at the rising histograms. But this is actually a wrong strategy, because when such moves occurs, it is too late to enter, and the market is very likely to reverse its direction and hitting most trader stop losses. Number 3 is establishing overbought and oversold conditions using MACD indicator. Most traders are tempted into using MACD as a way to find the overbought and oversold condition. This is actually not a very good idea, because remember, MACD is not bound to a range. So what is considered to be highly positive or highly negative for one stock or one instrument may not work well for a different stock or different instrument. And fourth and final common mistake that traders make are using the wrong time frames for trading. It is always advisable to use a longer time period to confirm the market direction, and then move to smaller time frames to take a trade entry, or else you will be going against the market, which does not always work in your favor. For example, if you are an intraday trader, you have to confirm the market direction using a larger time frame and then shift to smaller time frames like 15 minutes or 5 minutes to take the trade entries. The first strategy that we will be talking about is the signal line crossovers. A signal line crossover is the most common signal produced by a MACD. But a very important note to remember, use this strategy only in trending markets. First, one must consider that the signal line is essentially an indicator of an indicator. The signal line is actually a moving average of the MACD line. Therefore, the signal line lags behind the MACD line, which we have already discussed. So that being said, on occasions where the MACD line crosses above or below the signal line, it can signify a potentially strong move in either direction. The first type of signal line crossover is the bullish signal line crossover. A bullish signal line crossover occurs when the MACD line crosses above the signal line. And the second type is the bearish signal line crossover. A bearish signal line crossover occurs when the MACD line crosses below the signal line. But the strength of the move is what determines the duration of the signal line crossover. So understanding and being able to analyze the strength of the move using the histograms, as well as being able to recognize the fault signals, is a skill that comes with experience. But here's an idea to consider. We have talked about the zero line. What does the zero line actually mean to a trader? Consider if the 26 exponential moving average is greater than the 12 exponential moving average, it means that the MACD line has a negative value, right? And it means that the MACD line is below the zero line. And when will the 12 EMA becomes positive? When it is greater than 26 EMA, right? Also, 12 EMA is the faster moving average as it moves closer to the prices. its reaction to the prices are highly sensitive. Therefore, a bullish signal line crossover happening above a zero line is stronger than the one happening below it. Consider these examples for instance, where there is a bullish signal line crossover happening above the zero line and one happening below the zero line, and look how differently the price moves for each of the cases. The second strategy we will be discussing will be the zero line crossovers. Zero line crossovers are very similar to the signal line crossovers. Instead of crossing the signal line, a zero line crossover occurs when the MACD line crosses the zero line. That is, it either becomes positive or negative. The first type of zero line crossover is the bullish zero line crossover. In a bullish zero line crossover, the MACD line crosses above the zero line and go from a negative value to a positive value. The second type of zero line crossover is the bearish zero line crossover, which occurs when the MACD line crosses below the zero line and go from a positive to negative value. It is generally advisable to use both these crossover strategies together. That is, use the zero line crossover and signal line crossover together to get a much better trade result. The last strategy that we will be talking about will be the divergence. Simply put, divergence occurs when the MACD indicator and the price are not in agreement. For example, a bullish divergence occurs when the price records a lower low, but the MACD records a higher low. Similarly, bearish divergence is the opposite of a bullish divergence, and it occurs when the price records a higher high and the MACD records a lower high. The bullish divergence is an indicator of a strong reversal in the upward direction. On the other hand, a bearish divergence signals a price reversal in the downward direction.